Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to the third and final webinar in our exit planning series. Today's topic is minimize tax implications with estate and tax planning. Now, I noticed a lot of familiar names on the attendee list. I know many of you attended the first two parts of this series, and we're excited to continue bringing you this important information. Now, many of you are already clients of SVA, and we'd encourage you to reach out to your SVA professional if you have questions coming out of this. I'd also encourage you clients anyway, to share our contact details with other people you know who are looking to start the exit planning process and could use our help. Now, if you're not a client and you have questions, please reach out to me and I can get you connected to a subject matter expert at SVA who can help or get those questions answered. So if you've got a question or comment during the webinar, please open up the chat box in Zoom and submit your question to all panelists. We're going to try to leave a few minutes at the end for some general Q&A. And then after the webinar, you'll receive a link to a survey along with a link to download the recorded version. So in our first exit planning webinar, we covered building business value before a sale. Then last month, we talked about the due diligence and the valuation process. Now today, we're going to talk about the importance of estate and tax planning in the process. And let me introduce our subject matter experts. Dan Glomsky is a CPA. He's accredited in business valuation and is a certified valuation analyst. He has his master's in taxation. He's a principal in our firm. And then we've got Rick Colliff, who leads our estate planning area and has his JD, his CPA, CFP designations, I think one or two others. And you can tell by all those letters after their names that they spend a lot of time helping closely held and family-owned businesses through the exit planning process. So I'm excited to hear what they have to share today. But before I kick it off to them, let me start things with a quick poll question so we can get the pulse of our attendees today. What is your estimated time frame for exiting your business? Is it less than a year, 1 to 3 years, 3 to 5 years, more than 5 years, or not sure? And this will help guide Dan and Rick in their discussion today. Okay, so pretty across the board. Nobody's more than 5 years, you guys, but anywhere between 1 to 5 years or not sure. You guys have a lot to work with there. So enough of me. Rick, I'm going to hand it over to you. Go ahead.
Sounds good, Lee. And really the reason we asked that poll up front is it is really important to, from a business owner standpoint, to plan early, right? Because the closer in time you are to that exit date, it's not that you can't do planning, but the amount of strategies and techniques and the impact of those strategies and techniques becomes less and less. And we'll get into some examples on that and looking at it over a time horizon. But from the most standpoint, I mean, what's also very interesting to me as Lee kicked this off for us is that you've got me talking about estate tax, estate planning per se as part of exit planning, and Dan is going to pick up where I leave off from an income tax standpoint. And really those two are very correlated, right? Back as late as 2001, the estate tax rate was around 55%. The income tax rate was around 39%. And now you've kind of got the inverse where the estate tax rate has come down. The income tax rate stayed about the same. However, you've got some of these additional taxes like net investment income tax and other things that can take it above 39%. Then there's all this legislation. But the fact of the matter is, right, when you pass, and you have an estate and there is a potential tax for it, and the business is part of that estate, there could be an estate tax that you have to worry about. Until that time, though, you've got income taxes that you may likely pay on your business. So it's just, where's the tax optimization fall? And, while we really didn't build in here an analysis of those two concepts, I just want to point that out, that it really is important to understand the optimization and where we are with today's tax paradigm between estate and income tax and what the legislation might bring. So I didn't mean to take us off base, and this slide here really just brings together or ties up a little bit because this is part 3 in a three-part series on exit planning. But let's understand that, as I said at the outset, this is a longer term view where you can have a short-term strategy, but that's not the best way to plan. Planning involves time and understanding what your goals and objectives are. And the fact of the matter is, there's a comment here on this slide about those that maybe answered, I'm not sure. Well, try and get sure, because at some point you're going to want to plan that exit and you're going to say, I just haven't had time. Boy, I've just been so busy. I 24/7 in the business. But what I will tell business owners is, look, take 5% of your time and spend it on the business instead of 100% in the business, and you will be better off for it. You will monetarily reap the rewards on the transaction and in your estate plan if you do that as part of the business planning. Sometimes I think of the private equity groups that I work with from time to time when in doing merger and acquisition work, and whether I'm helping them buy or they're acquiring a business I'm working with. You know, what private equity managers do, they look at a business as they're viewing it to buy, and they're already figuring out what's the exit plan, because they want to know how they can build that business, grow it, and then ultimately turn it over. So let's understand that everyone's situation is different, but what isn't different for everyone is the need for that time runway. Okay, Jennifer, next slide, please. Okay, so what is the role of estate planning in your exit plan? And a lot of people think of estate planning as something you're planning for when you die. Well, your estate typically is considered your financial wherewithal as it is today, including life insurance and every asset you have. But the fact of the matter is, you might become disabled or incapacitated to a point that you can't run the business. So your estate plan documents would incorporate the provisions for what would happen in the case of your disablement or in the case of your passing. So understand that, and then understand that you need to control things or plan for things and provide for what would happen with the business, who would run it, how would they run it, what would happen if it's sold, where would the money go, how would the money go, who would get the money, in what way, shape, or form, would there be trusts involved, would they get it outright? These are all considerations that are part and parcel of an estate plan that should be embedded in your exit plan. I told Dan this morning. Yeah.
Rick, can I add just so one thing that I think we want to be kind of clear on is, we talk about death and we talk about disability and that type of stuff, but a lot of these things are good things that business owners should be doing, period, right? Because the more susceptible your business is to having, one of these events be catastrophic, not only from a personal perspective, but also for the business, that's a weakness you want to shore up. So when we look at business valuations, we look at planning and strengthening your organization, right? This is more than just an estate planning situation, right? This is about strengthening your business.
Yeah, I mean, you touched on it, and Nancy touched on it in the part 2 and part 1 in terms of, look, if you can make yourself replaceable, your business will be worth more. But the way to make yourself replaceable is to provide for what would happen in your absence or to build people over time. So yeah, the planning that's involved isn't just about estate planning, it's about increasing the value, protecting the value. But let's face it, if you are still the owner and you've got the vote, you need to make sure that not only do you have management and a team in place that can replace you, but that, hey, what's going to happen with that vote? How is the top decision going to get made? So you may be replaceable, but there are things that need to be provided for in your trust, in your wills, in your business organizational documents that look to these events. That makes sense, Dan?
Yeah, absolutely. And, just to keep adding on a little bit more, right? So if you start laying out my next generation or which direction I'm heading, it also helps you focus on where your business might go, but it's also going to help you sleep a little bit better. So I think, these things, what was on the first slide too, is there's so many different possibilities as we go through a lot of these things. Rick and I will share a number of them with you as far as our thoughts or things that we see and do. But there's a lot of variable options in this process. And you don't want to lose sight of what the end game is. And the end game really is, right, you want your business to be as successful as possible. You all want to provide for your family in the future and so forth. You know, again, it's like at each stage in this game, we want to make sure that we don't lose sight of what the, you know, what we're trying to accomplish when we go through either an exit plan or estate planning process.
Well said, well said. I mentioned to you just this morning when we were talking about today's webinar that an estate plan is not an exit plan, but an exit plan is not complete without an estate plan. So,
Right.
you know, let's jump to the next slide, Jennifer, if you will. Okay, so, you know, typically, what are some similarities and differences? We'll talk in this slide about some exit planning issues, and the next slide is estate planning issues. Because what we're trying to embed in your mind is this importance of this duality of this planning and how they're interrelated. So from an exit planning standpoint, right, we should already be familiar with, you know, understanding the business value. What is it worth? Who do you intend on selling to? And by the way, who you intend on selling to might dictate a price, because you might give or sell something to family that might be at a price different than you might a third party, but that's between you and your family, right? So then how do we protect that business while you're planning? In other words, we got a value, we like the value, but we're not exiting for 5 or 6 years. How do we keep it or grow it? All this is going to impact you getting from point A to point B, from where you are now to where you're going to exit, and understanding, is in the end what you will receive going to be enough for the rest of your life and the rest of your spouse's life and the rest of whatever family that you're planning for. And if you're charitable, is there going to be a component for that as well? The fact on the last issue, at least on this slide, as it speaks to, you know, are you going to continue to need to work in the business after? Or, you know, what do we need to do to maintain its value until you exit? At the bottom of the slide, I indicate that perhaps this starts to look at the intersection of where estate planning comes in. I think part of it really involves, don't give away too much too soon either, right? Understand, work with the planner, understand where you are, what you're going to need, what your value is going to get you after tax. And then let's make sure that you can stay there so that whatever transaction you use, if it's a sale to a third party, or and we'll talk about one of our transactions we call sale to an irrevocable defective grantor trust, or an IDGIT in a few slides. Whatever you're going to get, and whether it's going to be paid out over time, what interest rate, that's all going to be what you're going to need to maintain your lifestyle for the rest of your life. Jennifer? So here's some, on the flip side, estate planning issues. What are your objectives? Because planning really is about goal and objectives, and what are they? So who are you going to have that is your heir? How are they going to inherit it? How much is each going to get? When might they get it? Will it be paid out over time? What rights will they have to invade principal? All these types of things are things to consider. Who's going to administer your plan? Is it going to be a professional fiduciary, such as a bank trust department? Is it going to be a friend and family? I had an instance this week where a brother was involved. His brother had passed, his sibling had passed. There was a niece, the daughter of the brother who passed. And unfortunately, this gentleman is getting sued now because he didn't, well, she claims he didn't have all the investments in the right buckets, earning the right rate of return. You know, what I would like to say to that is it's not easy to be a fiduciary. So think twice about who you're going to name. Make sure you communicate with them, and that they, you know, willingly accept the role and understand what the duties and responsibilities are.
Yeah, Rick, that's a really good point. I mean, so many times we sit down with a client and we're going to go set up a trust or whatever the case might be, and well, we need to appoint the trustee, right? And what does that mean? And you know, how do clients select that? And you know, it's got to be also, you know, more forward looking. It's a very sensitive issue, but one that I think your point on fiduciary responsibility and really somebody's willingness to take on that role take some time to think through. And, family dynamics change and everything else. We got to make sure we're kind of giving that some consideration as you go through some of this trust establishment and so forth. I don't know if you have any thoughts as far as, what you see clients do in that process.
Well, I know what I see clients do. It's not necessarily what I recommend, but clients, have a mainstream mentality in terms of who knows the most about me and how can I get away spending the least amount of money. So they think friends and family first. I will say that to poke a hole in that concept, those people may not have the acumen to help run your business. They may not have the understanding or skill sets to do what's needed to be done. So they'll end up employing professionals anyway. So, it may be best to name a professional, or at least in a co-fiduciary role, right? Maybe that independent trustee, if you will, is there to provide the guidance necessary when the friend or family that you would like to select doesn't have really the right skill sets to make that role work. So, I mean, I guess those are my thoughts, Dan. Does that make sense?
Yeah, exactly. I mean, you're right. We have the option of we can appoint somebody. It could be a brother. It could be one of our children. That type of thing. But we also have the option of paying a third party trustee, right? And sometime that independent person that's taken that fiduciary responsibility as a profession might be a better outcome for you to consider.
And sometimes, depending upon the techniques we're using in estate and exit planning, we actually may require an independent professional trustee. For the fact of the matter is, if an heir is a trustee and they have certain rights to principal of your estate, that may be counted as part of their estate. And in fact, you may be trying to skip paying a potential estate tax, not only your generation, but the next generation. That's only one slice of, some technical points here. I think the last two bullet points relate to estate planning issues. And again, these are not exhaustive, but relate to businesses. And we'll actually talk about a technique later on and give an example of how discounting works. But understand that when you have a business as part of your estate, which of course is why we're having the webinar about exit planning from a business perspective, it's usually the largest asset in your estate and probably requires the majority of the planning. So some of these things related to capitalization on voting and non-voting shares, or splitting up interest into pieces so that you can get certain types of discounting, are all extremely important when you have a business. The last bullet upon if you're philanthropic and you have some charitable desire, there may be some techniques that you can use related to a charitable trust that provide you income tax and estate tax benefits. So understand again that estate planning is part of exit planning. So let's jump to the next slide. All right, so a very popular technique when you're transitioning to family, and say, let's just call it family G2. And the senior generation can use what's called an intentionally defective grantor trust, which is irrevocable as well. We'll refer to it by its acronym IDGIT. And an IDGIT is a tax-free transfer appreciation. So what is it? It's really a freeze in value. You're trying to take that business asset that's going to continue to grow, assuming it's not stagnant, and move it out of your estate. Not only move it, but the future appreciation, which is the biggest part of the scenario. It's done by using an upfront seed gift into this particular trust. So in order for the trust to be credit worthy, the IRS would like to see that it's got some type of wherewithal. So there is a gifting component that we like to see happen as part of an IDGIT transaction. And again, what we're trying to do is transition the business to the next generation, but we're using this vehicle, this technique called this IDGIT, whereby the beneficiary of the IDGIT is that next generation. So ultimately, they are going to get the business, but you're using this vehicle for this income and estate tax planning benefits. So it does remove the property from your estate. It will also use your lifetime exemption to the extent of that property. But more importantly, the appreciation from today forward will never see your estate, and no lifetime exemption will be used to remove the appreciation. That's why it's called a freeze, right? The transfer of the wealth continues throughout the grantor's life, because as long as the defective feature of the grantor trust, usually the feature is something like the right of substitution of assets. If you're transferring business into the trust, the fact that 10 years from now, you might substitute actually cash, buy the business back, you will not, but that substitution right creates what's called the Grantor Concept, meaning that it becomes a disregarded entity for IRS purposes. It's a real legal entity, it's receiving the business, but you as grantor can, and some people would look at me and smirk, what do you mean can pay the tax on the income that the trust is going to receive from the business? Yes, it is a benefit, because the tax that you continue to pay as grantor is not a gift under the IRS guidelines. It is not going to be using up either annual exemption or annual exclusion or lifetime exemption. Now, we also build in features in those trusts where you can turn that grantor feature off. The trust continues, you just don't continue to pay the tax. But while you're alive, if you are able to continue to pay the tax, it's another way to roll down your estate value.
So Rick, you said a couple things. I just want to make sure we're clear on that, right? So this is an irrevocable trust, right? So versus a revocable, right? So can you just kind of just touch on that just to make sure we get terminology clear? Because that's probably a lot of clients come to me with confusion as far as I have a trust, right? But it might be a revocable trust versus an irrevocable.
The most common revocable trust is designed to escape probate, keep things private, and keep things provisionally within a four-corner document. That's your living revocable trust that an estate planning attorney will help you set up as part of your original base estate plan. It'll include a will, it'll include powers of attorney for finance and medical power of attorney. But that is not what we're talking about here. This would be a second separate trust, because the revocable trust, any assets in that revocable trust or that would pour into that revocable trust are part of your estate, and you're not achieving any planning by doing that. You are achieving a good part of planning by avoiding probate, keeping costs down, and those things. But if you're talking about a business in achieving a valuation freeze, utilizing minority discounting, moving appreciation out of your estate, it has to be an irrevocable trust.
Which means that once it's in the trust, it's there. It's not coming out unless it goes to the beneficiaries, right?
It's there. Now, there are things that we as planners can build in, and we're not going to talk about spousal lifetime access trust today, but there are potential ways to continue to have access to a trust. We just don't recommend it. But the bottom line is, and I'm muddying the waters, I know, the irrevocability of the trust is key. Sorry, let's jump to the next slide, Jennifer. So how does this discounting work, and what is the process for setting up this widget, and tell me more about it, right? Because the beauty of it when doing it right is having an asset, let's say that's worth $10 million, that ultimately you can transfer for $8 million of use of your lifetime exemption. So you've evaporated $2 million. The IRS didn't really even have to know about, but you need to do a few things to make that happen. Your entity should have voting and non-voting shares. If you're an S corporation, you might say, well, I can't have more than one class of share. That's the only thing that can be different amongst S corporations shares, is that there can be voting and non-voting. You need to get an appraisal of those shares so that the qualified appraiser can ascribe the correct amount of discounts for lack of voting or for marketability or for minority interest. Then you would set up the trust. You gift a certain amount if you're going to do this as a sale, as we talked about before, called the seed gift, usually 10% of what you're going to transfer to the trust. And then you can gift or sell either the remainder of the business, The slide here speaks to this $11.7 million number. We were talking to clients early on in the year about trying to use your lifetime exemption this year because was scheduled to go down through legislation that doesn't look like it's going to happen before the end of the year. However, take note, it still is scheduled to happen by law at the end of 2025 because the tax law that brought it up to $11.7 million today is scheduled to go away and sunset, as we call it, at the end of 2025, back to about $6 million. So what we're trying to have clients do is use up their entire exemption amount, because when it goes down, the IRS can't come back in and say, oh, you gave more than the $6 million number that you only have an exemption for. No, there actually is guidance out there that says, if you actually did use it all, we can't come back at you. So there was some urgency, if you will, to this early on in the year. The fact of the matter is, this transaction works well no matter the size of your business, because what we're doing is freezing the value today. Remember, future appreciation out, continue to pay tax over time. Then you would go ahead, Dan.
Go ahead.
Then you would make the transaction itself happen, whether it's the sale of the business to the trust or a part of the business to the trust. Oftentimes, we'll sell first that non-voting interest, which could be as high as 99%, but non-voting, continuing to keep the 1% to the business owner so that they can make sure that the business thrives while they're getting their proceeds back. And then the magic to this, how it all works. How does the trust pay it back, or the beneficiary pay it back to the business owner? Well, distributions from the business go to payment every year, just like you're making distributions now. The business, the trust itself then can either utilize those funds to pay down the note, or as we can see in the past, maybe the business owner doesn't need that entire note paid along the way because that business owner has enough resources outside to continue to pay the taxes, or the business the note can actually be set up as potentially a self-canceling note. The IRS really frowns on those types of transactions, but that is a strategy that can be employed. So either the note is paid off, we like to see that if it can be funded through distributions, or it can be maybe it's interest only, and then maybe self-canceling at the time of the death of the business owner. So another trick you employ is utilizing maybe a lower interest rate. The AFR is the applicable federal rate that the IRS prescribes, somewhere south of 2% these days, but we all know that lending money is higher when you're going to a bank. So the ability for that note to be paid off at a below market rate interest rate, although it's not below market under IRS standards, the fact of the matter is you're giving the benefit to that beneficiary to pay at this nice interest rate.
Yeah, Rick, remember, none of that. So that interest that's being paid to the grantor, the person that held the shares, is not taxable income to them, right? It's moving cash back into their estate, right? Which is, what we're always worried about. But from a taxability perspective, we don't pay any tax on the gain or the sale of the stock. We don't pick up any interest income from this note, but that it's just really more of a cash flow transaction versus a tax consequence of doing this event.
Correct. Thank you for pointing that out. As I mentioned before, as long as it's a grantor trust, the IRS disregards it for income tax purposes, not for legal tax purposes. So any transaction between the business owner and the trust is essentially a transaction between the business owner and themselves. So you can't sell something to yourself and report a gain or loss on your tax return. You can't have yourself pay yourself interest and have a taxable event. So that's how that works out. I will mention that from a transaction standpoint, as we build out these marketability and minority discounts, there was some talk of legislation again early on in the year that would have looked unkindly towards some of our discounting measures. And while that is not in the current legislation, and is not set anywhere in law to happen in the future. Some of us might recall the IRS had rolled out some regulations under Section 2704 that were taken out once they were proposed. I guess I would say to you at this point, again, from an urgency standpoint and a planning standpoint, if you're going to talk about doing any discounting in planning, do it now, because there's no reason the IRS couldn't propose those 2704 regs again, and there could be negative consequences on how we look at the ability to discount going forward. So all is not put to bed on legislation. It never is. Anytime there's a new Congress, anytime there's anyone that can introduce legislation, things can happen. Best part about planning is planning puts you in front of those things. Next slide. Let's talk about a little example here on how this works from a freeze standpoint. So here you have a business owner today. The business is worth $11.7 million. Coincidentally, that happens to be your lifetime exemption. So if you were to pass today, your business, your family doesn't have to worry about estate tax. But that's the straddle, right? That's very close. It's spot on. Fact of the matter is, you're going to continue to work in this business for 5 more years. So here the example says, well, you grow this business to 14.625 million, which isn't all that uncommon. In fact, it's really only a 5% IRR. If you grow that business 5% one year, and then on top of that 5% the next year, this is how it gets to that value. Most business owners would see that as something below their standard. Anyway, here's the example. Well, the lifetime exemption, for our example, stays about the same. Well, we know it goes up with inflation. It stays the same, 11.7. You've got a taxable estate now. Guess what? You've got a new partner. His name is Uncle Sam. Uncle Sam is going to take out of your family's pocket $1,170,000. So you just work for 5 years, 5% IRR. Count that down, because after tax, your family's only going to get the 13.455 million. Now you might ask yourself, why do I keep working? Well, that's something you might want to actually think about. But let's look at the next slide and see what happens if we use a gifting maneuver. So that 11.7, can we go back just real quick? I just want to show something, if that's possible. So 11.7, let's assume that's a discounted value. Now to the next slide. The pre-discounted value in our example is, if you back into it, $14.44 million. You take a 10% lack of control, 10% lack of marketability. That got us to the 11.7, right? But if we were to do that transaction today, if we were to gift that business that's really worth 14.44 million today, 11.7 after discounts today, and we still grow it to 14.625 million, we're not going to have to pay an estate tax. Why? Because all of that future appreciation from today forward will never get to your estate. So that's the beauty of the technique. And if you look at the next slide, it just shows the math that you've saved for yourself. You've gone and saved that $1.17 million. Uncle Sam is not your partner, your friends and family. And if you wanted to be charitable, give it to a charity, just got that amount of savings. So I caution by disclosure, again, always look at legislation, always look at regulations that could be issued. But while we sit here today, we have the ability to do these things. So now is a good time to do that planning. And somebody said, a client said to me the other day, well, 2026 is 4 to 5 years away. I said, it's still going to happen. All the clients that we did planning for when we thought legislation was going to happen before the end of the year are still happy, because they've moved the growth of the business for this year out of their estate already. Right, Dan? I mean, all the planning we've done, clients have still been very happy.
Absolutely.
All right, so we have a quick poll coming up here, poll number 2. The question is, do you have a written estate plan in place? Please answer yes, not in writing, or no. We like to ask this question because people think they know what's going to happen, but I'll tell you that if it's not in writing, it's not likely to happen. After this poll, we're going to hand over to Dan. He's going to talk a little bit about the income tax implications. So here we have that same, varied split that we had on the first question. Yes, you guys should have kudos. Not in writing. Let's get started. And no, well, I caution you, please get moving. So let's close out that poll and move on to Dan and the income tax implications of a sale or a family transfer.
Sure. So we're going to get into some exciting stuff as far as like some tax planning or things to kind of think about as we go through an exit strategy. But I think it's, from a kind of a due diligence perspective, right? The whole part of this process is more than just taxes. And so what I want to, kind of do from a editorial perspective is just kind of go through, things that you want to be thinking through and making sure that these decisions are, really in the best interest of what you're trying to accomplish. At the end of the day, we can save all the taxes, but if the asset didn't go to the right person, or you ran out of cash, or whatever in our big scheme of things, then we failed. So as we go through a lot of estate planning and exit planning, even when I'm talking to a client as far as how much they want to sell their business for, right? They'll come to me and say, hey, what's it worth? I'll tell them how much it's worth, right? And then the question is that enough money for them to walk away from the transaction and do all the things that they want to do, right? So it's, what's your lifestyle expectations? Give that some thought, and it might require us modeling out what kind of income you might have and where you go with that. Personal goals, right? Does it give you the security? Some people have a benchmark in their mind. It's like, hey, I wanted to sell this business at this level and that type of thing. So, we want to look at that. And then, do you have enough in retirement? Do you, plan to travel? Do you want to gift, a lot to charity? Do you have, a child with special needs? There's a variety of things that need to come into this planning process that is not tax related, right? But it all works into the process. And then, how's your health, right? How many years are you going to keep doing this? Do you have other hobbies? Are you going to, stay busy and that type of stuff? Some people's life is their business and they want to keep doing that. And maybe there's a result where we allow them to continue to be involved, but maybe not in a management position and that type of stuff. And, we talked about the exit as, the defective trust and so forth. And we have the voting and the non-voting. And those are all things that we put in place, not only from a discounting perspective, but also so that you can maintain your goals as far as staying involved in the business. Not quite ready to turn it over, but want to do some estate transfers. So there's a lot that goes into this process beyond just taxes. So let's go into the taxes a little bit here. And the reason we kind of added this slide is a lot of times people get hung up on the purchase price. I'm going to sell my business for $50 million. Okay. Well, that's great. You should be set, right? Well, the reality of it is we got to understand that you might sell your business for 50 million, but the business might have 15 million or 15 million of debt, right? So then we got to give some working capital back, and then we got to pay taxes. And then, oh, by the way, the attorneys and the accountants are going to get their transaction fees, or the broker, and all before you know it, you're sitting there holding 23 million, which again, great number, but not necessarily 50 million. It's, it's less than half. So when you go into this process, we just can't stop at the purchase price and say, okay, I'm getting the purchase price of my business is worth. It may not produce the result we're looking for. It may require us like, okay, I want to sell, but maybe it's 3 years down the road. I need to build a little more cash position, strengthen that company a little bit, maybe get the price up a little bit. So that's really what we're trying to make sure we drive home in this particular slide. And then we go into the effects of the transfer. And, there's a lot here, okay, to be honest. And, when we have an exit, we can sell a business for, sell the assets of a business, and we can sell the stock of a business. And when you sell the assets, the buyer is interested in buying your assets because they can depreciate that over time and start getting some reduction or some benefit for the money that they paid you for your assets or your business. Where you sell them the stock, then the buyer just has the stock, and there's no, for the most part, when we talk corporates like S corporations and C corporations, there's no ability to get a deduction for those particular price, what you paid for that purchase. So there's two motivations here, right? We got the seller, they want to do a stock because it's all capital gains for them, which again is like a 20, 23%, whatever, the situation might be. Whereas if I sell the assets, it might be a 37% tax rate or a 30% tax rate. So we got those two competing tax rates. And so it affects the value of the business, but those are things we want to pay attention to as we go into this. Again, a seller, you want the stock transaction, right? Because it's the most, the cheapest tax that you'll pay as part of that transaction. Then we have the structure, right? Am I a C corporation or an S corporation? And this plays into our analysis from a couple perspectives. We like the S corporation because what an S corporation does is all the income that the S corporation makes passes out. There's no corporate level tax. It all goes to the individual tax return, and the individual pays the taxes pays at once. Where if I do a asset sale of a C corporation, that corporation is going to pay the tax, and then I'm going to liquidate that what's ever left in that C corporation, and that is either a dividend or a capital gain to me on my individual return. So there ends up being a double taxation that occurs, and so we want to kind of play that through. And there's also an option for what is called a 1202 gain exclusion for C corporations. This could make it the gain that comes out of that C corporation when I sell that stock not be taxable. The reality of that is maybe got a short life here. I don't know whether the proposed changes are going to ultimately eliminate it, but it's definitely been on the bills that we've seen so far. I don't know whether it maintains it there or not, but those options do exist. So whenever we're doing a transaction, we're looking to find out, can we qualify for this? Does it benefit us to be a C corporation? When we talk about planning, this is an event that you can't look at a 1202 exclusion today. You have to start that process when you form the company or issued new shares, that type of stuff. So here's where the planning comes involved, right? It's like, what is my entity structure? What kind of tax options are out there as far as the exit strategy? And then how do we position ourselves? So this is one thing we would look at during that process. There is also the ability, and it's called a 338H10, where an S corporation can sell the stock, and a buyer would want the stock in certain situations where there's like a lot of agreements where we want to transfer proprietary rights or whatever it means, and where you can't necessarily transfer that by just doing an asset transaction. So the buyer's really interested in a stock transaction for that purpose. You're interested in from a stock transaction for capital gains purposes. But then the buyer says, yeah, but I want to also depreciate the assets. So then there's an option of making this 338H10 election. What it really does is it converts it from a stock transaction for tax reporting purpose to an asset transaction, which usually means we got to increase the purchase price because you as a seller are going to pay more taxes. And again, these are things that we want to be thinking through as we go through the process as far as options. What can we do as part of that process to pay the least amount of taxes, but also negotiate the best purchase price.
And when I'm hearing and my experience tells me is that obviously for the seller, the best deal is in most instances a asset purchase. And from the buyer's perspective, the best situation again generally is for a stock sale. And then from a pass-through or non-pass-through entity standpoint, and there's all that planning that either can go in on the front end of organizing the business or perhaps converting mid business. And then what am I getting at? You know what? This requires analytics, and it's not always the business owner that's equipped to do these analytics, so that they'll come to us. And we represent both buyers and seller. And look, while the seller sometimes has the upper hand in how the deal is ultimately going to be structured, doesn't mean that you can't negotiate based on what your tax implications are. The taxes aren't always going to dictate what you're going to be allowed to do when you're selling, especially to a third party, but that doesn't mean it can be part of negotiations.
Right. So when we talk about, like, next slide is the purchase price allocation, and you know, these are really more so if I'm selling the assets of a stock of a business, right? And I want to, you know, there's strategies with respect to that, right? Do I, you know, if I have what is called like machinery and equipment, I might have depreciated that. So if I sell that asset, I have all this recapture tax and stuff like that. So it doesn't give me the capital gains rates and stuff like that. So purchase price allocation is also something we pay a lot of attention to. There is also an option to do like an installment transaction where you have the ability to recognize that gain over time as you receive your cash. There's situations though where we will accelerate that and say, no, we will do the installment sale, meaning you pay us over time, but I'm going to pick up all that income in the year of sale. And the reason I might do that is, let's say I think capital gains rates are going to go up, or let's say this investment income taxes is going to apply in the future and it doesn't apply today. These are things that might change, and we certainly want to plan for. So then really the desire to have a tax efficient transfer, you know, really comes down to, you know, and we have this on the next slide is, you know, am I going to transfer it to the family? Is it, you know, what am I going to do, you know, in these situations? And here's where we talk about the trust and whether we do a partial gift or whether we do a sale. And here's where we use trust and so forth. The thing I want to drive home with everybody in this particular situation, when you transfer an asset or interest into a trust, and let's say it's an S corporation or a partnership, the distributions that you may have been receiving from that entity now go into the trust. And either that money is now going to come back to you because you, in essence, sold the stock on an installment sale to the trust. But if you made an outright gift and put that asset into that trust, that cash flow goes into that trust and continues to grow inside that trust. There's other things, rules we have to apply around that, but that's one thing that we always worry about is with clients is them understanding the cash flow consequences of some of these transactions. So if just a quick example, I know we're running out of time here to kind of go through some of these things, but in this particular example, you know, what I'm really just trying to drive home is the change in the lifetime exemption. And so we go from 11.6 to potentially 6 million in 2026. So we're looking at, you know, just another, few $1,000,000 of difference as a result of not acting today and letting things kind of roll out and doing something, you know, 5 years from now or 4 years from now, whatever that might be. So the bigger piece here is really just kind of trying to lay out that example. Can you go forward 2 slides to the ESOP? So the other thing we have is a strategy of kind of an exit plan is kind of an ESOP. I'm going to mention it only as an option and one where we feel that clients have been considering it because it allows the business kind of to continue under its current management and everything else. But the reality of it is there's, you know, you can get your purchase price, you know, based on a business valuation and that type of stuff. Keep your employees, keep everybody going. So that's one thing we should consider if you're thinking of an exit strategy and you want to kind of keep things as is. Rick, can you go into the next slide, please?
Sure. So we've talked about how a business owner might go about minimizing the estate and income taxes as part of a exit plan, and optimally, what does that help the business owner accomplish for those that they care about once they pass? And here I want to talk a little bit about, well, we've also mentioned that there are points in time throughout this process that you're going to need to rely on others to help you formulate these strategies and tactics to get you from this goal and objective from where you are today to where you're going to end up, point A to point B, because you can't do it all yourself. You're going to, you know how to make the widgets, but you don't know, you know, some of the things related to the financial and legal components and considerations that are necessary to finish the planning, to draft the documents, to implement some of those strategies. So a CPA, an attorney, a valuation professional. You might also look at compensation experts, because when you're designing an exit plan, keeping people in the business, your management team intact, and so that they don't leave, perhaps once they hear that you're thinking about exiting, maybe getting the right compensation in place, or maybe creating stay bonuses, a pool of that, what they might get in the end upon an exit, upon a transaction, are things that you enlist a compensation expert for to help you in that planning process. Bankers, of course, if you've got current debt, what are those debt covenants that you need to live by? What might you help a buyer with in terms of banking based on where your entity is today? Investment advisors, of course, to help you financially plan from what your non-monetized value of your business is. Once it's monetized, how to live with it. And then insurance to keep things protected. Now, one thing that's not on this slide is I talk to a lot of family businesses, and oftentimes it's dad, mom, maybe Sarah and Jane, and Joe, the son, daughters and son that are the board. Well, that can work, but you're not getting necessarily the best advice. Shouldn't the best practice be that you've got an outside board? And if it's not, say, your full board that runs the governance, maybe it's at least an advisory board. I think so much value can be added to a business through having an independent outside advisory board. The skill sets that are brought to the table can incorporate some of these advisors that ultimately you will need to hire. But if they're also perhaps part of your board or an advisory board, they can help you along the way and continue you on the right path, so that it's not always this internal family that's got its own ideas. And here you're being able to garner this additional subset of ideas outside of your family. So that's what we counsel our clients to look for in developing an advisory team. You should have that in place now, right? That shouldn't be something that you're trying to set up when you're trying to do your exit.
Yeah, and Rick, the big thing here is, you don't have to, right? It's really my recommendation that you kind of, seek out other input, right? There's a lot of things here, and we talk about the tax strategies, we talk about making sure the trust documents have what they need. You talk about, evaluating, whether you have enough cash flow modeling and that type of stuff. A lot of times we think and we're confident in what we believe and think. The reality of it is sometimes we don't see what we need to see. And advisors can hopefully get you to, maybe see it differently and come to the same conclusion, right? Or say, oh, yeah, I need to worry about that a little bit more.
Yeah. I mean, I think we talked about this as early as part one in the series. I had a business owner, I wasn't presenting in part one, but I had a business owner who thought their business was worth, I think it was $6.5 million. And they had a certain lifestyle, so we knew what we needed to get after tax. But when we ultimately had it appraised, because when you go to market and you look to sell your business, you're not going to do it blindly. Even if you're not doing any type of significant strategic trust planning, you're still going to get it appraised and make sure you get the right number. And the appraisal comes in like $4 million. So after tax now, we don't even know if we have enough. So having that appraiser there, that's just one example of one professional that you need on your team that's going to help you in the planning process. So just one example. We have one more poll left, and then we can get to some questions. In this particular poll, we ask, based on today's webinar, do you think that you need to create and or update your estate plan? Please answer yes, you need to create one, yes to update, or no, you're good. And it kind of just gives us an idea of, has there been any call to action here? Do we think that we've convinced you that those of you that early on answer you have one or you don't have one in writing? Where are you today after this seminar? Lee, I hope you're looking if there are any questions. For those of you that didn't put questions, please put them in chat. And so here we have 50% that do need, I believe they need to create one, 20% need updates. That's 70%. So I hope that those of you that answered those questions, yes, will seek out the guidance of those advisors that we recommend that you have on your team.
Yeah, great. Dan and Rick, you guys, so much good information. Third webinar on this, a lot of information over the last few months. We have had a couple of questions come in, but I'd encourage you all to send in any questions that you have. We have a few minutes to go over them. We had some specific ones around that 338H thing you were talking about, Dan, but I think maybe we can reach out to those people specifically, as they were very specific questions. I think one of the things that I hear people ask a lot is, and you kind of touched on this just a minute ago, Rick, like, or Dan, I'm not sure who it was, but sometimes we don't see what we need to see. Can you guys share maybe some examples of where you've seen exit planning gone wrong? I guess when they're not maybe using the right team, where are those common mistakes?
Yeah, I would say that we're, from a planning perspective, it's somebody saying, oh, I got enough money to walk away with X amount of cash. And after we start including, health insurance, or, they want to travel more, or they, are not going to have the distributions that they had before, all of a sudden things come to a screeching halt because they don't have enough cash flow coming from the proceeds, right? So, or so really it's really, I see a lot of it in the cash flow planning. And I fear that we grew up saying, oh, $1 million is a lot of money. Well, the reality of it is $1 million today is not what $1 million was 10, 15 years ago, right? I mean, it's still $1 million, but it just doesn't go as far. And then that's where we really need to be active in this process. And then we've also seen family dynamics change, right? So somebody gifted something to, a trust, and the beneficiary was a particular individual, and something didn't necessarily go right there, right? So you want to make sure there's provisions in there so that you can make sure that there's a little bit of control yet in that document to help you.
One of the things I see gone wrong most often is not planning far enough in advance, because first of all, you don't always know when that time is going to happen. If you have an accident, if you pass, let alone, what is your planned runway? Is it a few years from now? Is it tomorrow? Or ultimately what I see happen, we can almost always help someone save some income and or estate tax in the transaction and planning for the transaction, even on a very short runway. But what I don't always like to point out, because it's just, you can't do anything about it. But usually what I can see very clearly is if someone would have come to me at least 5 years in advance of selling the business, and the business value is this, and it's grown to this is how much income tax, this is how much estate tax we could have saved you. You lost that opportunity because of time malfeasance. Now, what can we do in the transaction as it's live, as it's growing? Hey, you called me up and you got an LOI and you need to respond. Great. What do we need to do? But if you would have planned for it 5 years ago, there's a whole chunk of other money we could have helped you save.
Absolutely. And, I know we have clients that are serial entrepreneurs and sell multiple businesses, but for most of our clients, they get one shot at this, and you want to make sure you're doing it right. Guys, we just had another question come in about ESOPs. I know we had to sort of skip over that real quick, but they're just asking about tax implications of ESOPs. Do you not pay any taxes?
Yeah, so the ESOPs do not, they're in essence
employee benefit plans.
Yeah, so what happens is you sell to the ESOP. So if I'm the owner, I sell to the ESOP, there's tax consequences on that transaction, right? But then once that entity is now in an ESOP, they don't pay any taxes until the beneficiaries, the employees or whatever, take a distribution out, withdraw from the ESOP or whatever. Then there's a tax, just like a IRA or retirement account. That's the significance. There might be some other minimal taxes, but for the most part, it's really a tax deferral entity, and that's the benefit with an ESOP.
And that tax savings the ESOP garners helps pay the seller. And if you're a seller and you're a C corporation, you can elect Section 1042 treatment, which might provide either a tax deferral or permanent tax deferral if you die with that 1042 replacement property. So, you know, it depends, right? But an ESOP is a tax efficient method for transferring a business.
Okay, well, we're at 1 o'clock. Rick, Dan, great job as always. As we wrap up, I just want to let everybody on the webinar know that you can visit svaccountants.com/ or actually just svaccountants.com, where the recording this webinar will be located, as well as e-guides and articles, upcoming events. So this was the last webinar in our exit planning series, but next week, Thursday, we're doing our year-end tax planning webinar. And if you haven't had enough of Dan, you can sign up for that too. It's got a specific emphasis on recent legislation and what you need to know.
You can never
And
have
lastly,
enough of Dan.
What's that?
You can never have enough of Dan.
If you say so. All right, lastly, I just want to remind everyone that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA contact as questions arise. And if you're not currently an SVA client, reach out to me, Lee Schwartz, and I can get you connected to a subject matter expert or get you the answers to the questions that you have. So thanks again for joining us today. Have a great rest of your day, and we hope to see you at our next webinar on December 16th. Have a good afternoon.
All right, thanks, guys.